This is my topic here, the role of actuaries in life insurance. So this is a way I'm planning to discuss today. So let me do what we are going to do today. So good. So this is what I am thinking of doing it today. I'll be defining about some contract, what it is, and actuary, and what the actuaries do in life insurance, and different management structures and stakeholders, how actuary is important in a life insurance work. And the objective of this is by understanding the roles and responsibilities of an actuary in your life insurance company will help you to make your qualities, your skills and your requirements, to shape your requirement, your skills and your qualification. All these things you can understand what is required and what is the work the actuaries are doing at life insurance company, and what are the things I should learn before stepping into the industry. That's the objective of this session, and let's see how it goes today. And so friends, before getting into the core topic, in the life insurance topic, why life insurance is required. So my thought process goes like this. It is a very simple thing. One, it is a contract between two persons, right? One person is paying for something and another person is promising something. The entire insurance is acting based on this simple definition. Let's understand what it is. A contract is under which one party accepts a significant insurance for another party to compensate a policyholder if a specified uncertain future events adversely affects to the policyholder. So one person is paying for that you take some risk for the future events which it is going to happen, and for that I am paying you something and you compensate for the loss if it has happened in anything in the future. It may be a certain period, or it may be a long-term period, whatever it is. It may be a short-term period. So this is a simple agreement between two parties. Just because of this simple agreement only, the industry functions. You need many actuaries, you need many departments, you need many qualifications, you need very rigorous examinations and professional qualification. Many things are there. All this because of this small thing. Only some 4 or 5 lines definition. So the entire today's discussion is built up on this basic thing, right? So with this understanding, let's see what is who is an actuary. Maybe actuary, it may be, you may not be willing. You may have different versions, different definition. And Zilla is also said that actuary is like this. But what I look from my perspective, who is an actuary? If I ask, the very first thing is, what I can say is, actuaries are expert. You may be agreeing or you may not be agreeing, or the other profession may agree or may not agree. But from my perspective, I can say actuaries are expert. In what area they will be expert? To assess anything which has some financial impact and financial impact of an unknown, uncertain events of the future. Again, I am repeating why I am calling they are expert. Actuaries are expert in giving you a financial and to ascertain a financial impact of some unknown, uncertain event which is going to happen sometime in the future. So this is a basic definition. Let's see what further, how it works. The another view is they will do something, they will take some decisions, a financial decision to be, to take the financial, they will make some financial decision by doing certain activities. What are they? They will analyze the past. How they will take the decision? They will analyze the past. They will model the things in the future. Based on that, they will assess the risk involved in the uncertain event which is going to happen in the future. So, analyzing the past, how they will take a decision, how they will assess the financial impact by using the past information, what they have. They will analyze the past information and they will model, using that information, they will model it for the future. So model it into the future is an interesting one. What you do in the projections or whatever, it may be a deterministic, it may be a stochastic, or it may be a whatever way it is. It may be a simple one year projection, whatever it is. So using the past information and modeling it into the future, and based on the model output, you will be assess the risk involved, which is going to happen in the future. You will assess the risk involved in that event numerically. That's very important. You assess the risk involved future unknown event and explaining it with numbers. So this is the methodology the actuaries are in. Now, don't you think that actuaries are expert? Is there any other profession does like this? For an unknown event which is going to happen, for that you use the past information and model it and assess the risk. I did not find any such kind of profession which they will do like this and getting this. So that is what I am saying, that actuaries are expert in assessing the financial impact of the tomorrow's uncertain event. Now, not only this, okay, I assess the future event, okay, fine, unknown event, I'm assessing by using various methods, all these things I'll make it. But how the third person will understand that one? What I will do, I need to communicate in their language, right? I need to communicate what that result is actually reflecting it in the financial terms. In a non-technical terms, I need to explain it. That's the important, that's the communicating the result, what you have obtained by using the past information, modeling it into the future, assessing the risk and determining and communicating that numbers to a non-technical people in a financial terms. So that's very, very, very important, friends. So because of all these things only, I am calling it as actuaries are expert. Right? Okay, now actuaries are doing something, maybe what I said, some analyzing the past, modeling the future, assessing the risk. So it is also reflecting something, some other profession, right? Can you relate it? What I feel is actually a fortune teller, because a fortune teller will tell something whoever it is, what is going to happen in your future. Okay, if somebody goes, some person who can tell the future of the event. Okay, today I'm like this, I'm very sad, right? You tell me what is that. You tell me what is going to happen in the next 3 months or next year, like that. If he asks, he's actually a fortune teller. He's actually professional is like that, right? Because they are also using it. That guy also is going to use my past information, and he will do something. He may be having some sort of instruments. Maybe today now it is a system they are having it, and with this system they will put some date of birth. They will do this, and they will get some pictorial representation, and then they are also using. This is also a model for them, and with that they will tell you in the future like that. Is it like that? Actuary's work is not like that. So actuary is an expert evaluating in the likelihood of future event using the numbers, not by crystal balls or dice or some other instruments, right? So they will determine, they will say that yes, with this event, with this, they will attach some probabilities, you can say technically, with this probability, and this will be your likely events. It is going to happen. How? Based on certain things. How I am saying my model is reflecting. What is the basis? My past information is like this. And with that input, with that modeling aspect, my results are saying like this. My numbers are saying like this. And if you continue like this, if the past trend is like this, with this set of assumptions, with that set of models, restrictions, and this is my outcome, and this is my future, this is the and with this future will be with this much credibility, like that the analyst says always. It may be any sort of work, it may be a life insurance work, or it may be a non-life, or it may be whatever be the work. It involves any uncertain events, any future uncertain events. They will give you a financial sense of it with certain amount of certainty. That is the work of an actuary. So actuary is not a fortune teller, but he will give an expert advice on the likelihood of the future events, which has financial sense. So this is what which I would like to share it. Any questions you have now so far? If the understanding is clear, then we can do that one. Any questions you have? And where is chat box? I'm not getting the chat box. I need to stop sharing and I have to see the chat box, I think. And with that, only possible. Chat box, it is not coming. Is it visible now? Is it visible now?
Yes, is it visible? Yes, sir, it is visible.
My screen is visible or what it is?
No, sir. No, sir.
Okay. So good. Very nice. I think some Azan has replied all good. Steffi, thanks for your things. Vinaya, good. So I think it looks good. Okay, let us continue with this, and further I will continue the presentation. So Abhishek, thanks Abhishek. That's good. So let me continue sharing this and okay, I think. Okay, let us discuss about what actuary. So understanding the role of actuary, what actuary is, and with that understanding, let us see what the actuaries are doing in the life insurance companies. So our point of discussion will be relatively to the Indian atmosphere, or generally in any geography. If you see, by and large, the actuaries' work is related to this aspect. I have covered maximum thing which I can do that, which I can think it of, and all the things my maximum level I'm covering it. Let's see one by one. The first and foremost aspect is the product design. So for any life insurance company, the products are very important. That is the one of the important thing where the life insurance, because that is the business they are doing it. So they need some product which needs to meet the customer needs, and products are very important, and actuaries are well versed in the product design. They should understand the customer needs and what the competitors are doing in the market, and how is the product is meeting the needs of the customer. So all these things actually should be well versed. It should be always in his fingertips. Then only he can design a product for a company. So product design is very, very important aspect in the life insurance company. Once you design a product and pricing is slightly different. Designing a product is understanding the various stakeholders' needs, and you need to develop, you have to give a structure to the product. For example, what are the benefits to be benefits needed in the product, right? That is called the design. What are the benefits? It may be a death benefit, or it may be a disability benefit, or it may be a maturity benefit, survival benefit. There are various kind of benefits, and what are the benefits should present in a product? That is called a product design. So that design, that is the one of the primary activity, and that is called product design. And product pricing is another aspect. Product pricing is you have a benefit which is having certain, which is going to happen on based on certain contingent event, and for that, what premium, what price I should charge for that, right? How much premium I should charge to take that risk, or to pay that benefit to the customers. So that is very, very important. So that is called product pricing. So actuary has to do that pricing activity. And the profit testing, okay, you set a value, okay, this is my premium, it may be in some unit rate or some fixed amount like that. Some, for example, let us say some 5 rupees per 1,000 as a premium rate, and whether that rate is sustainable for a company to run. So that is the another interesting aspect. So you need to test for the profit. Okay, if I go with this rate to the market, and whether my company is able to earn certain amount of profit. How will you do? There's a rigorous testing, rigorous process. It is there. There is a model. It is there. We need to do that, and with that, all these things we need to test that profit. How much profit I will be earning it if I give this value to the customer, right? And it should be consistent. It should be acceptable, and there are many aspects into it, and it is very, very interesting. And for a whole day, we can talk about the profit testing, pricing, product design, all these things. They are such a interesting and very very lovable topic to discuss about it. I'm not going to discuss about today. It is just an introduction. What they are doing in the life insurance company. So I'm not explaining much about it, but it is one of the interesting aspect of the actuaries' work in the life insurance. Then another one is another very, very, very interesting and very important work in actuary life insurance company for actuaries are valuation of the policy liabilities and assets. So valuation is a very, very important exercise. So what is meant by valuation? Valuation is, so you are selling a product to the company. Customers are purchasing your product. And as I said in the definition, the definition says the policyholders, the customer will pay some amount to you, and you need to pay some benefit by taking some risk of that policyholder, and you have to pay back to the policyholder. whenever the contingent event happens. Suppose if a policyholder survives at some point of time, you have to pay back to them. And if it is a death happens in the future, then you have to pay. So for that, you need to assess in today's term how much I should keep as a reserve to in my account, so that that amount is sufficient to pay the policyholder's need as on when it is due to be paid to the policyholder. Some amount you need to keep it today, so that that will be useful, that will be paid to the policyholder in the future whenever that event occurs. So this is called, in a simple terms, in a non-technical terms, if I say, this is the definition of the reserve or valuation. So not only that, it is not that you are liable to pay, it is not that liability, the assets also, it is very important, how much assets parallelly I should keep to meet the liabilities which is going to occur in the future. So valuation of the policy liabilities and asset, it is a very, very important work and very challenging work, and also it is a continuous process, and we have to develop the expertise in this type of work continuously. Each and every day it will be a challenging aspect, and I would be, in my experience, I can say that valuation, if I touch continuously, I was doing valuation for a long period, and even today, if I start working on valuation, it is a new learning for me. Because the situation, the policy, it may be a simple one. It may looks like that it is a known information, but when you actually dive into that aspect at that particular day, then it will be a new aspect to you. A lot of challenges you will be having it, and that makes the work more interesting in this. So another aspect, another work the actuary does in the life insurance company is a determination of solvency. This is very, very important work. The actuary is a person who is well known in the life insurance company about the solvency. Solvency is, suppose I'm having some 100 crore rupees today, and if something happens tomorrow, and whether I can pay back to my liabilities to the customer, or my entire funds will go out and I cannot meet the customer's requirement or not, whether I will be solvent at some point, at every point of time in the future. That is the big challenging question. So determination of the solvency, it is very, very important work, and actuary has to do. There are various methods of doing the solvency calculation. In India, we used to follow a deterministic approach. It may be it is based on the formula-based approach, where you will have some percentage of your reserve, some percentage of your sum at risk, and with that you will be having some. You have to keep some 1.5% of the total liabilities as your solvency capital. These are the regulatory aspect generally they will do. There is another method called the risk-based solvency determination. So each and every risk you need to assess it separately, and for that you need to ensure that at every point of time the company is solvent. So there is another basis called Solvency 2 methodology. So there are various ways it is coming. There is one more new method it is coming. I forgot. IFRS way of approach. There are many things it is coming in. So there are various ways to determine the solvency of the company. Of course, it is guided by the regulator, and whatever regulator says to demonstrate, that it is the life insurance company should do that. And that calculation can only be done by the actuaries. So determination of solvency is very important. So next one is the reporting. Reporting is various reportings are there. There are reporting to the regulators, reporting to the shareholders, reporting to the policyholders, reporting to the public. There are various aspects. So various numbers will be generated based on your calculation, and various readers should understand that numbers. So you normally actually does many calculations, and with that calculation, what is to be shared to whom, that he should understand, and that too the way they need. That is very challenging aspect. So reporting the numbers to the readers of that numbers. It may be a regulator, it may be a shareholders, it may be a board of a company, it may be a CEO of a company, it may be to the general public. There is various reporting aspects. So all these things will be done by the actuaries. And none of the numbers will go out of the life insurance company unless actuaries approves it. That's very important. Without actuaries approval, a number will not go out. That's the importance of the life insurance company. It may be a regulator, or it may be a shareholder, or it may be an outside world. Actuary has to agree, accept, approve that numbers. Another one is experience analysis. It is very interesting, and it is a very all the actuaries will focus on this experience analysis, because actuary determine for each and every work there will be a data, and there will be an assumptions actuary used to set for each and every work. If it is a pricing, they will take it as some assumptions relating to that particular product. And if it is a valuation, he will set some prudent assumptions. Prudent, it may be he knows what sort of level he has to do that. So he will understand. He will set some assumptions. And if it is an embedded value calculation, it will be another set of best estimate assumptions, or any other assumptions he will use. So various assumptions will be used, and based on that, he will be determining certain result. But when a product goes to the market, when it consumed by the consumers, and if it is come back to us with after some years, when experience emerges, then you need to understand whether the assumption what you have done that work is actually what is happening in actual world. So the understanding between your assumptions and the actual thing, so that is called experience analysis. So with this assumption, I am getting this number. In actual, if I am getting, for example, let me tell you with simple example. For example, I assume I priced a product with assuming that there will be some 5 deaths per year, right? So that almost some 50 lakhs will go as a outgo. With that assumption, I priced my product. I kept my premium rate is like this, and after over a period, I got some actual experience that 10 deaths have occurred, and I have paid some 1 crore rupees to the public, to the policy holders. Then the experience comes, then actuary has to see why there is a huge difference. What has happened between my assumptions, and whether assumptions are right, or what has gone wrong in between. There are many reasons. Ignoring the calculation part, there are many other reasons between the assumption and actuarial. So actuary has to analyze those things. And if it is if there is any requirement in the need in the change in the assumption, then actuary has to change those things in the future, or he has to withdraw the product, or he has to go with something new, or some changes he has to. There are various ways for corrective measures. So experience analysis, by and large, what you have to understand is certain assumptions we do some work, and over a period it will gain some experience, and you will have a real-time data, and with that you need to understand what is an impact of between your assumption and actuals. That is called an experience analysis. Only actuaries can do this work. Capital requirement is a very interesting thing, and this is very, very important for the shareholders. So suppose if I want to run a company and with 100 crore rupees, and you are doing some business and you are having some products, and suddenly at some point of time the capital is not adequate, and where will you get it? The shareholder will be, every time shareholder will be asking the actuary, what is the requirement, how much you will give. First question is how much you will give it to us. Then actually, if it is a new company, actuary will never say that I will be giving it to you, but you have to give it to me. So it will not go for a long time, but at some point of time, they will ask you the return. So capital requirement, the actuary should monitor the requirement of the capital periodically. How? By doing various analysis. Right? Whatever we have discussed so far, all those things will be used, and he will be assessing the requirement of the capital. That is called the cost of capital. How much capital it is required at some point of time. So that is called the cost of capital requirement. That is very, very important work. And if you if you go to the appointed actuary's cabin in any life insurance company, the first question is, are you asking any capital? How much capital it is there? Like that only they will ask. So that's the monitoring the capital requirement is very important. So that is what it is. Model office projection I will tell you later. I'm not going to take this one. This is very important. Guide to the management is very interesting. Why? Because I mean, it is an actuary is a complete control over the entire functions of the actuarial. I mean, entire functions of the life insurance company. Because wherever you go, the actuary guidance is required. So he should know each and every aspect, functions of the life insurance company. Maybe you ignore the HR. Other than that, you should know what is happening in the company. So in that case, you have a control, because you are the creator of the product, and you are the assessing the capital requirement. You are assessing the liabilities and assets of the company, and you are analyzing the experience. With that, you have a complete picture, end-to-end picture you have, and with that one, you only knows what is going right, what is going wrong. And with that aspect, you need to guide to the management of the team, the board of directors. That is what it is a mandatory. The regulator has made mandatory that each and every board meeting, appointed actuary of a company should be present. He should be invited to the board meeting of the company. Whether CEO is there or not, it is very immaterial, but appointed actuary is must for each and every board meeting. If they are not inviting it, then appointed actuary can send a message to the regulator that board meeting has held on this date. I have not been invited or for these meetings. He can say that these are the meetings held. I have been invited for these meetings. So he can make a report. Then it is the responsibility of the regulator to ask the board of the company why you didn't call the appointed actuary. The board has to justify it. So that is the power the regulator has given to the actuary. So when you have that kind of responsibility, it is your responsibility to guide the board and the management that this is the current status, and this is the level of your company, and we need to take these are the corrective measures which I am recommending. You have to take that one, and you need to inform the management and the board, and you have to suggest with your recommendations. So that's very interesting, very important. If in practical sense, if board meeting is happening, if appointed actuary knows that board he has been invited, the entire actuarial department will be in a different shape. Each and every person will work to provide that information to the actuary. So people used to stretch, they used to sit for a long time, and they do many analysis, and they will give their findings, and they will discuss with the appointed actuary, and it will be shared to the management. So it's very important. It's a periodical activity. The regulatory responsibilities, the regulators, the only point the regulator believe, only person the regulator believe in a life insurance company are appointed actuaries, because they are the representative to safeguard the interest of the policyholder. We will discuss about that later. What are the things about responsibility he has? So he is a custodian of the policyholder's interest. So he has a lot of responsibilities. That is what, if appointed actuary is appointed, before appointing an actuary in the company has to get the clearance from the regulator. And the regulator will be calling the appointed actuary, I mean, not the candidate, and they will interview the candidate, and then they will clear it. Okay, you go and work in this company as an appointed actuary. They will give a written confirmation that, okay, we are okay with that. Like that, the recruitment will be done by the company, but the responsibility of discharging the actuary lies with the regulator. So it is a regulatory responsibilities. So that is what, even if you see the regulations also, appointed actuary regulation is having, it is a separate regulation. There is no CEO regulation in the regulator office, but appointed actuary has a regulations, because he has that kind of responsibility. He has to safeguard the interest of the policyholder. So regulatory responsibilities, it is very one of the another functions of the actuary. Okay, so any questions on this? With this? Any questions? Let me stop sharing this. If you have any questions, let us discuss about it. And if you are clear, then write clear. If you are not clear, you can talk to me. If you have any questions, you can raise it.
So we have one question, that who is a regulator?
Who is a regulator? Okay, yeah. Okay, regulator. Regulator in India, it is called Insurance Regulatory Authority of India. It's called IRDAI, Insurance Regulator and Authority of India. That's the statutory body set up by the government of India, and all the life, general, health insurance and reinsurance companies are controlled, monitored by the IRDAI. So they are the regulators. They will give guidance, and without their permission, with their permission only, they will they will be running the entire insurance industries was guided by them, will be controlled by them, will be monitored by them. So is it okay? Did you understand this? Did you got it? You need more information? Is it
Yes, sir,
okay?
we have, we do know, yeah. How do we proceed to work in actuarial department after completing my master's? Another
Okay,
question.
interesting. Yeah, that's what I want to plan. I want to tell you about that. So how to proceed to work? There are some certain skills. What we can do, we will discuss about that last. Or Shalini madam, how long we can continue this? Or with this understanding, shall we go back to this one, or shall we do something more and then we will go back to that?
Sir, it is up to your choice. You can go ahead.
Okay. Okay, fine. So that I will answer correctly about that. What are how you have to do that? Okay, then any other questions you have? Otherwise, we will continue with some more time with the presentation. Okay, I think that's there is no further questions. So let me continue with this. Yeah, I will share my screen. Yeah. So the next one is one of the, as I said, it is the responsibility of the actuary to introduce you have to price, you have to design, you have to price it. How it will be? It should be a financially viable, actuarially sound, and customer beneficial product. So each and every word is very significant here. How it is financially viable, why it is called actuarially sound and customer beneficial product. I'm not going to discuss much about it, but it's a very interesting topic to be. Each and every word is significant here. I will just send the customer beneficial product because for the customers only we are giving the products. So it should be beneficial to the customers. Otherwise, what will happen? There will be a mis-selling. If I want a term assurance, instead of term assurance, if they say if I purchase endowment assurance, then it is not beneficial to me. Suppose if I am able to take a risk, so that I have much risk in a financial, if I want a good return from the market, then I should go for the unit linked products to get a better returns. So instead of that, if I take an term product, it is not going to use. So it depends upon what sort of the customer needs, customer beneficial product that has to be given. So it is a responsibility of the actuaries that they have to provide that kind of things. So let us not discuss much about it, but a very interesting one, viable, actuarially sound. These are all very interesting to be discussed. We will discuss some other day that we will do all these things. Maintain solvency of the company, we have already discussed. Monitoring experts and take adverse deviation, we have already discussed it. Monitor and improve the company's KPI. Yes, this is very important. Each and every life insurance company has different key performance indicators. For example, some company will set that my renewal ratio is some 99% or 95%, assume that. That means, suppose if I am selling 100 policies this year, then I am expecting that next year, all the out of 100, at least 95 policies should be in force in the next year. Right? This may be my target. What happens? People will dissatisfy and they will not be in a position to. There are many factors to why this is not happening. So one of the key performance indicator of a company will target like this, because with that level they want to earn, because if policies are not renewed, then your profitability will reduce. Future profitability will reduce. Then if it is not reduced, if it is not certain amount of policy is not, then your expenses will increase. The other people has to share their overhead expenses. There are many aspects to that. So it is one of the main aspect, that persistency. They call it as a persistency. How much a policy is renewed each year. Sometimes nowadays, even the regulator is monitoring this one. You give some 13 months persistency, 25th month persistency, 37th month persistency, like that they used to ask the companies. So one of the key performances like this. Then another one, maybe you may imagine that at every point of time, my profitability of the company of the particular line of business should be some 5 or 7%. So that may be one of the performance indicator that company has to go with that. So if anything is going, or if there is any deviation, then the actuary should inform to the management, inform to the board, and they have to take a corrective action. So it is a continuous monitoring is required for key performance indicator. So this is another area, and another expertise is required to perform this kind of monitoring and improving the performance indicators. So that's the another important work. The regulatory professional guidance, that is another important. The actuary not only he is a custodian of the policy holder, but he has a professional responsibility. If at all you want to work as an actuary, then there will be some guidance from the professional body. In India, we call it as an Insurance Institute of Actuaries of India, where we all write examinations and used to get qualified. And it is the professional body in India, which gives some certain guidance to the professional actuaries that you have to follow under this work, you need to follow. These are the guidelines. These are the information which you need to take care. You need to follow this. So it is a responsibility of the actuary to follow those guidelines. If he is not following, they will take disciplinary action against the actuary. There are many examples. I can quote that one. I think it is out of scope of our discussion today, but that is what it is. The professional always gives some guidance notes called. It is called. Previously, it is called guidance note GN like series like the 8, 9, 10 like that for life insurance, and now it is called some new name they have given. I forgot that. I will tell you if I remember. But that is the thing they used to give all the time. Practice standard, APS. It is called an actuary practice standards. So that is the guidance note they used to give. So actuary has to follow those guidelines. And if it is not followed, if somebody complains against the actuary, then professional will involve and they will take actions. There are many examples. It happens. Even the professional took that and they debarred an actuary that he has not complied with that for the 3 years, like that, and all. It happened. There are many. It's another altogether a complete discussion, but this is very important aspect. He has to comply and he has to follow the professional guidelines and recommendations continuously. Yes, I saw that draw the management already. We have done see that draw the management of any matter of concern. So because he has a huge responsibility and he has that all the information before him. So he's a person who can draw the attention of the management. Suppose, for example, if company is not meeting the solvency requirement at this point of time, then immediately he has to bring it to the notice of the board or to the regulator, wherever it is, and he should bring that corrective action is implemented into the company. That means the appointed actuary has a huge responsibility. Oh, okay. I think it is already 1 hour. Anyway, I will wrap it up this one. And see, as I said, actuary is one of the important person in the life insurance company. He has to interact. He has to discuss many things with many people in the company, the CEO, CFO, the chief investment officer, IT head, and board and chief marketing officer. Many people used to always interact and always come for the actuary's guidance. When I remember my LIC days, I was as a junior officer there at that time, and it is very difficult for me to meet my own the actuary of an LIC. So very difficult we have to stand up for a long time. We have to wait because many people used to it is always a busy, one of the busiest person in the company, and very difficult to meet, to complete the day-to-day work of day-to-day guidance, day-to-day decisions from the actuary. That itself, it is difficult for his own team members. So that's the level of thing it is having. Lot of things it is there. So that's the responsibility he has. He has to take care of all the people around him. That's the importance of the actuary. So actuary and chief investment officer is, I just, instead of describing all, I just took two examples. One is how the actuary and CIO, chief investment officer, plays a role here, how they are related. So actuary helps the chief investment officer to determine appropriate investment strategy. Because when policyholder pays for certain risk or certain amount, and they have to, that amount has to be invested into the market. And if we are doing it, they are expecting some returns. So to meet that one, some investment strategy needs to be developed. The CIO will immediately, they will put it into the market and he will get some return. But whether it is a correct method of doing it, how much risk he is taking it. For example, let us consider. So there are certain assets which I need to pay at the end of the next year. For example, annuity payment you take next year, pension if a person survives, and you have to release a pension of some 1 crore rupees next year. But today I'm having only 90 lakhs. But I need to invest it and I have to pay. These are all definite payment which I have to pay. Suppose, okay, I need to the 10 lakhs, it is a problematic. So if you give it this amount, if you say the investment officer that I need to pay this one to the next year, you have to pay 1 crore rupees. Then he will put it in the equity and he is confident he will get it. But annuity is not the case. Suppose if anything happens, if market crashes during this period, then what will happen? It will be a tough time. So it should be an appropriate investment strategy. Where to invest, how to invest, what sort of risk he can take. So that kind of strategy needs to be built up. Actuary is one of the important person to design that kind of strategy. You can do some sort of, this is the rate of return, and with that rate of return, this is my, okay, you invest this much amount in that, in certain investment funds. For example, equity, you put it some around 10% or 20%, put it in the bond market, some 50% for this kind of liability. So that will be this one. Yes, for this, there will be a strict regulations because these are all the policyholders' funds. The regulator will be monitoring those things, how it is invested and how much return they are getting, how much they are giving back to the policyholders. Strict regulations are there. Advices on guarantees. Guarantees are very, very important. Guarantees means, for example, at the end of the 5th year, the policyholder definitely will be getting this much amount. For example, 50 rupees per 1,000 as a guaranteed amount. That will be a benefit like that. If that is the case, then it is very challenging for an actuary to assess how much risk he needs to take on it. So such kind of guaranteed payment, actuary's involvement is very, very important. You may use stochastic models, many things to assess the guarantees required. So those things will be done by this one. Asset liability matching is very, very interesting. This is very interesting, friends. You have a liability on different, and even some few days before I did this exercise for an insurance company. So it is very interesting, assets and liability matching. You will be having some sort of assets. Your chief investment officer will be giving that this is the assets I am having, these are the investments. But your liability is having a different structure. It may be it differs by nature, term, it differs by amount. There are many aspects in that. But you need to match these things appropriately. If needs to be changed, then it is to be changed correctly. Then only the liability will be met in the future. So asset liability matching, it is called the ALM exercise. So that is very, very important. So actually plays an important role. There will be a dedicated team for that to doing this exercise. And with that recommendation, the CEO functions. So not CEO, CIO. Risk management. Yes, if you, this is another topic. Now I am skipping it. Risk management is very interesting. If you take all these things, then it will be a part of this one. One full day we need to talk about risk management. So I am just skipping this one. Admissible, immutable, it's okay. Choice of fund is very important, which I said that help to setting the investment strategy. So how to set the what sort of assets you need to do, whether it is rated assets, it may be a AA plus or A plus, or whether it is risky assets or it is bond asset, whatever it is, it's a corporate bond or it is a government bond, those kind of decisions, it's a responsibility of the actuary to provide. CFO is a very interesting aspect. Actuary and CFO has to work. Even some actuaries, appointed actuaries, become CFO of a company. Because once you are an actuary, then it will be in fact, they are very much relaxed when they become a CFO of a company. CFO activities, they will go together. CFO means Chief Financial Officer. He is a custodian of the company's funds. So that is what it is. So for a CFO to function, the business plan is very, very important. So what are the products, how much product they have to sell, what sort of, from which product, how much income we should get, and what will be the size of that one. If this is a size, what will be my expense structure, what will be my future profit, all those things it is required. So management also needs that kind of planning. For the next 5 years, insurance companies should have their business plan, whether they have to focus on unit-linked products or traditional products, or it is a group product or individual product, like that, different things it is there. And with that combined plan, they have to achieve the profitability. So actually, does a business planning activities. That is very, very important for the CFO. So each and every year, every financial year, before starting the financial year, 3 months before the starting the financial year, the company plans for that. Like our government of India, how they are planning a budget session before April, it is they are going to, but they will give it, prepare a budget and present it to the parliament in the month of February itself. Like that, the life insurance company, people used to plan, a business plan activity will be done, and that planning will be for the next 5 years of the company, and closely they will monitor over a period. So CFO plays a very important role, and actuaries is very, very important in playing that role. As I said, the capital, affecting the capital, if capital is slightly changing, then CFO will immediately, cannot sit in his seat. He used to come to the actuary. What is going on? What is going on? It is very difficult. Then it is a very hot issue for him. So it is a responsibility of the actuary to advise on capital issues. Solvency we discussed, I'm not going to do. Helping in budgeting. Yes, for example, for this year, how much expenses the company will be facing on it. So for that, what will be the expected numbers? That will be provided by the actuaries. So this input is very, very important for the CFO. Cost of allocation, whether it is for how much bonus you need to allocate to the policy holders, how much shareholder transfer should happen from the profit earned in the company, and what will be the future allocations if I continue the business like this. So those calculations will be provided, and that will be a great input to the CFO for administering to prepare his balance sheet. So what is that? Multi-phased actuary, yes. So actuary is has many stakeholders. He has his policyholders as one of the main and foremost stakeholders. He has a lot of responsibility. The shareholder is the another person who is bringing capital to the company. So it is a responsibility of the actuary to satisfy the shareholders at every point of time. The regulator, as I said earlier, he is the nominee of actuary, he is a nominee of a regulator. So he is another stakeholder. Whatever happens, all the communication will be done through the actuary. So a regulator is one of the stakeholders. As I said, profession is another important institution where actuary has to fulfill the needs. Let's see what are the responsibility as for the policyholder he has to do. He has to satisfy the policyholder expectations. Policyholder expectation is altogether a different topic. It is very difficult to determine. However, actuary used to adopt many techniques. For example, if you sell a product to a policyholder, you will be giving some information to the policyholder. Okay, this is my benefit. This is your benefit. For this, you are paying this premium. If you pay this premium, you will get this this much amount at the end of your policy period, policy term. there will be two scenarios. For example, one is optimistic scenario, another one is pessimistic. If optimistic, if the company is in optimistic, then you will get this much, and if you are in a pessimistic scenario, you will be getting this much. So this kind of information he used to give it to the policyholders. So based on that, the policyholder creates its own expectations from the company. Okay, if I invest 1 lakh rupees today, I will be getting some 1,50,000 rupees at the end of the 10th year, right? So for that, he used to, that may be the expectation the actuary is creating. If you are creating that expectation, then you need to fulfill. So it is a responsibility of the actuaries to manage the policyholder expectations. It may be a bonus. Today you are giving you 40 rupees per thousand as a bonus. Next year, policyholder will be expecting, I need 40 rupees. If you increase it, he will be happy. If you increase it to 45 rupees, he will be happy. If you reduce it to 30 rupees, he will be dissatisfied. So actuary has to manage the expectation. That is the very, very primary aspect of the function. And the illustration at the point of view which I explained it to you. So these are the things which we need to manage with respect to the policyholders. So shareholder is always interested in the capital and how much capital they have to infuse and how much return they have to get it back. Not only that. Okay, today I'm getting, okay, today my dividends are like this. For example, I will be getting the dividend of some 10 lakhs rupees this year. Next year, at least I need 10 lakhs. At least I need 15 lakhs. So if that is the case, how, what sort of business actually a company has to do? So it is a responsibility of actuary to manage that shareholders' need. The actuaries may, the shareholders say that on equity I should get some 15% return from the business I need. So actuary has to work for that. If that is the case, what will be the need of business strategy is needed for that. So actuaries are responsible for that. So shareholders expect a clear-cut communication from the actuary periodically. It is very, very essential that the actuary should brief the shareholders with the numbers, whatever he has. And he has to explain it to them that this is the current status. And if you do this, you will be reaching this stage. And with that stage, you will be getting this one. And policyholder will be getting this one. That sort of communication, periodic communication, it is a must that the actuary must do to the shareholders. Regulators always insist the actuary that they should follow regulations. Whatever they are giving guidance, whatever directives they are giving, it is responsibility of actuary to implement it in the life insurance company. And if they violate it, they will take action against the actuary by putting some fines or some sort of stopping the function of the actuary. I think in India, one of the company it happened. Sahara India, I remember. Yes, Sahara India was one sudden the regulator were instructing them that you have to follow these kind of things, and somehow the Sahara management was not doing it. Then one fine morning, they issued a circular that some people will from the regulatory office will come to the company and they will take the entire functions of the company, and all the CEO should go out of the company. Like that, they took a drastic decision. That is, they are watchdog. The regulators are watchdog of the insurance industry. They have a huge powers. And they will go, they will warn, they will do all, they will go in their step-by-step action procedures. And if any violation happens, they will step into it. So this is the major decision. There are many insurance companies, very famous insurance company used to fined by the regulators. Many examples I can quote: SBI, ICICI Prudentials, and Bajaj, Allianz. All they violating some sort of regulatory actions, and the regulator involved in it, and they put some fine, 25 lakhs, 50 lakhs, 1 crore, like that. They used to put some fines on this. they issue warning letters to the appointed actuary. Many actuaries got warning letters. When I was handling the valuation responsibility, my actuary came one day, one fine morning, he brought one warning letter from the regulator and gave it to me. I was shocked by seeing that one. And then I felt that it is then something which I missed it, that as an actuary, valuation responsibility that I missed because of that, you may get. And he said it is not like that. The regulator expectation is different, and we didn't satisfy, and that and all it happened. So they may issue warning letters. So regulations are very, very important. As I said, we have to act professionally. They have to follow guidance note periodically whenever the profession instructs to do that. Why they are doing it? Because they want to have uniform practice as an actuary in the life insurance company. Right? One actuary may decide something like this. The another actuary, there is a famous saying, no two actuary will do same work, will do same way, like they used to say. So there are, because of their expertise, knowledge, the approach may be different. But as a profession, as an industry, it is a responsibility of the profession that it has to be, standard practice is to be followed. For that, they used to give guidance. So it is the expectation of the profession that they have to actually should follow. For that only, they are doing all these things. Good. So this is what it is. Any questions on this, friends? Let me stop at this point of time. So let me see whether any questions you have. Any questions you have? Asset liability matching looks like a balance sheet. That is a different one. I am talking about. It is not a balance sheet like that. It is a matching of the risk-related work. For example, I have 10 years. At the end of the 10th year, I need to pay some 15 crore rupees to the policy holders. So I need to match that one, that liability. That is my liability. For that, I have today, I'm having some 50 crore rupees. But with 10 years, I need to find out some appropriate instrument so that with minimum risk, I meet this liability of 1 crore rupees at the end of the 10th year. For that, what assets I need to invest? That is called asset liability matching. That is not related to the balance sheet. It is literally an assets. What you have, and the liability is what you determine in terms of nature, term, or amount, whatever it is. Balance sheet is pertaining to maybe accumulation of the past. I am talking about the future. I think Lakshya Valia, you got it or not? Good, very good, thanks. Any other questions? Otherwise, I will go with that interesting one. What is that? Oh, somebody asking, can you give some example of asset liability management? This is an example I gave. This is example. This based on the term. One of the matching is the term of doing it. For example, after the 10th year, I need to pay some 15 crore rupees to the policy holders. I'm having today 10 crore rupees. At the end of the 15th year, I need to match it. How to do that? Yes. Can you send us the PPT in the WhatsApp group? Okay, fine. We can do that. That's not a problem. Then any other thing? And if not, then the very important thing the students need from this session, we will go with that. That's the interesting thing, which you may like it, I hope. Fine. With this, let us go back to the presentation again. Again, I'm sharing it. And So are you able to see my screen?
Yes, sir, we can see.
I think PowerPoint doesn't. Yeah. Now is it okay? I think it is visible now, right?
Yeah, yeah.
Okay. So these are all, friends. These are all the functions the actuary does in that. For that, he needs a team. A single person cannot do that. He needs a team of technically qualified and experienced team to do all this work. In day-to-day activities, the actuary cannot see what exactly they are doing it. He cannot go to the model or cannot see the number. By seeing the numbers, he can make decisions. Right? By seeing the numbers, he can take some decisions. But he needs a team to perform all the activities what I have described here. So if that is the case, the team should have that technical expertise. It may be in pricing, it may be evaluation, it may be an asset liability modeling, it may be a modeling aspect, it may be an reinsurance aspect, or it may be an any reporting side, key performance indicator, whatever be the actuarial work you do, you need the expertise in that field, in that area. So with that, the actuary expect that if this person is there, then we can function this one. Based on that, they will set some expectations at different levels. Right? In similar way, the actuary expects that how a new student can contribute to the work of a life insurance company as an actuary. So what the qualification, the skills the actuarial students should have so that they can discharge their duties, which will be significant contribution to the actuarial work in the life insurance company. So with that, the expectations from the students, from the young talents, what are the expectations? Let us list it out. Data, assumptions, and models. This is very interesting topic for me. Whole day I can talk about this data, assumption, models. The entire actuarial work revolve around these three things. It is a must that data is a must for every actuarial work. So I have explained to you pricing, modeling, product design, whatever it is data. The form of data may be different. For example, pricing, you may be having a model points. Okay. For example, my target market is educated, well-educated young people, where like age between 25 to 35 years. So this product needs to meet the needs of that customers. So for that, what should I have in pricing? I need a model point 25, okay, 25, 23, maybe 20, 25 to 35. I need some model points. So maybe some assured, maybe some around 1 crore rupees, like that I can have. But if at all, if you are in valuation, then the need of that one is valuation needs a complete data, which is an enforced policy data it is required. All the policy information is required for doing a valuation exercise. There are various forms of data. So data is very important. It may be even reinsurance work. It is KPI work. Whatever it is, data is very important. Like that, assumptions are important. Each and every work has assumptions. Without assumptions, you cannot do anything. If you have data and assumption, what we will do? You need an instrument. You need a medium to put those things into that one place, and with that you need to perform some process. It may be a projection, it may be some model runs, whatever it is, and that medium is required. Some tool is required, that is the models, and from that output is taken back, and with that only we will be doing all the activities. So data, assumptions, and models are very, very important. It is the expectation of the actuary that the student actuaries should have a sufficient, adequate, reasonable knowledge of data, assumptions, and models. Right? I'll tell you some more thing about this later. The second quality which they expect is analytical ability. And it is not wonder that Actuaries is expecting this one from many people. Because whenever you have a data, you need to analyze it properly. Right? Whenever you have some assumptions, you need to validate it properly. Right? Whether it is a suitable, whether it is a not suitable, or if so, at what level. Models, yes, naturally. Without analytical ability, you cannot do any model activity. So analytical ability, it is very, very important. So my suggestion to you during your studies is try to understand the numbers, what you are working on it. Don't do mechanically. Anything, don't do it mechanically. For example, let me tell you one simple example. You calculate IRR, right? Internal rate of return. Maybe you might have studied in the subject of mathematics of finance, right? IRR activity. So IRR, you know what is that? You'll be having some few cash flows. There will be a positive cash flow. There will be a negative cash flow. Then by solving it for I, you will get the internal rate of return if you are familiar. And if I am explaining it to you right way. If not, you have to ask your staff members, all of that. Catch hold of those people, right? So this is the way the IRR calculates. This is the a bookish knowledge, right? So when people come for an interview, I used to ask, what does it mean by IRR? Some people, they will remember. Some people, they will not remember. First of all, they will simply say, I studied in the first semester, that too first chapter I will study. After that, I forgot. They will say like that. There are many candidates I have met. They used to explain me like this. But what to do? Ignore those people. But who said that, okay, IRR means, okay, this is what it is, IRR. They will say very nicely, they will say, okay, fine, IRR, you know. How will you calculate? They will say, I have a time zero, there is a possibility, there is 1,000 rupees to one project, they will explain. Not cash flow, for they will take a project. Their project A has minus 1,000, second year 100, third year 100, fourth year. Some problem they might have seen in the book. So they will say that IRR, I will get some 5.2%. The another project is having a minus 500, 200, 200, 200, and I will get 5.95. So I will choose 5.95. This is an example they have worked in their CT2 exam, first semester, first chapter. Right? They will explain to me correctly. So what I will do, then, okay, fine, that's good. Whatever you are studied, excellent. I will not do, I'm not contradicting you. That's good. Okay, I will give you one example. Can you calculate and explain me how it is calculated? I used to start with like this only. I have a premium. Every year, policyholder is paying a premium of 1,000 rupees for 10 years. At the end of the year, you will be getting some 12,000 rupees. At the end of the policy term, you will be getting, or sum assured is 12,000 rupees. Right? Now you calculate IRR until like that. Then the problem starts there. You may not believe, friends, I might have asked this question for maybe around 50 candidates. I would have interviewed around some 500 to 600 candidates in the past 10 years. Maybe I might have asked this question to 100 candidates. None of the candidates so far, they answered this question. A simple example. Those who don't know, those who forget first semester, first chapter, CT1, that is a different issue. CT1 or CT3, I forgot. So that is a different issue. I am not talking about it. Those who explained me project 1, project 2, IRR, and if you ask this question, if I put my simple question, and then okay. Some candidate I used to select without asking this question. Imagine. Without asking this question, they have come to my team. So practically, I used to give some work. Okay, you carry on this one and you do this one. Same example. In reality, I'm telling you the reality. What is the reality? You calculate this one example. I simply give all these things, final result. You take this one and you calculate me this one. Morning, I used to give 10 o'clock. I was expecting in 10 minutes, they will be giving it maximum 10 minutes, maybe 1 hour, maybe new student, newly joined, they may not be comfortable with this one. So they 1 hour, they will not come. Half day, they will not come. Evening, they will not come. Then while going, I used to see this guy used to sit and I used to call, what are you, why are you sitting here? Then I used to ask, IRR, what IRR? IRR I'm calculating. Morning you gave no me, sir. That only I'm doing. What nonsense you are doing for calculating IRR? I used to ask. So they will be struggling with when the practical things are given, it becomes tough, even though they know the concepts. Why? There is a mismatch, right? So this is the actual situation, friends. Thinking of unusual situation. This is another important thing. Whatever you are studying, it's a good. But in practically, you may have different situation. Day-to-day life, you have to face many challenges. You may be well known with a particular set of particular concept very clearly, but in practice the things are different. For example, let me tell you one thing. Calculating reserve calculation, right? Okay, fine. You are calculating. You have some examples. Age 30 years, and for endowment, for policy term 10 years. At the end of the 5th year, TV, you will have some formulas, and you will get some this one from this table, that table. You will put that one. All these things. But for that endowment, that is fine. But if there is a change in some sort of benefits, what will be the reserve? You may not be knowing that actual things, but by seeing the numbers, you need to tell. This is an unknown situation. You may be knowing certain things, but you may not be knowing the other things. But the challenge is you are expected to do that unusual situations. So how will you get this kind of practices? While studying itself, what do you have to do? Okay, if I am doing this for endowment, if I am doing it, what will be the same thing if I do it for term assurance? For example, take this reserve calculation. Okay, reserve 35 years, 10 years. My reserve is like this for endowment. Suppose if I do it for term assurance, what will be my reserve? If you develop this kind of capability, then you can easily handle the unusual situation in the real world. Yeah, ability, application of the technical concept. This is very, very important. The level of expectation is, it is a simple, but over a period, it is increasing now. The people are very good at technical concept, bookish concept, what they read in the books, and when they have the practical implication, if you are, as I gave an example of IRR, when you put it into the practical thing, it is very difficult. They might have seen some 5 point of time the cash flow, but actual cash flow may be 100. How to do that, right? So they will be struggling it. So this kind of the technical concept, putting the concepts in your technical way. You may be good at the knowledge. For example, let me tell you one other famous thing is prospective reserve and retrospective reserve, right? Prospective reserve and retrospective reserve. You might have studied in CT5. Those who have studied may be knowing it. Those who are not studying it, it is also fine. You may be studying in future. Whenever you study this one, you will remember my words. So prospective reserves and retrospective reserve. If you ask this one, they will tell immediately, okay, prospective reserves are accumulation of the premiums or benefit expenses, all these things, and this will be this one, and with that retrospective reserves, it's the expected present value of all the benefits plus expenses minus premium, all these things they will tell. After that, one question, when these two things are equal, then gone. You are saying both are reserve, but when this will be equal, whether it is equal, when this will be equal, in your textbook they have given it. But in practically, if you say when it will be equal, for that you should have worked it. Then only you will know. Otherwise, it will be very difficult. In practically, in where I will be using, I will be ensuring. Suppose if I am building a model, right? So I need to ensure if I am calculating a reserve, then I need to calculate both way, prospective and retrospective, ensure that if both are equal, then I can confidently say that my model is correct. Right? So the application of the technical concept is very important. You have to learn this technique while studying itself. That is what I would like to say. The software skills are very important, friends. Nowadays, the people are expected to know some software. Like in life insurance company, it may be expected that you should be well versed in the Excel, because people are coming like that. They have some good knowledge about Excel. Excel in the sense that come very comfortably. For example, if you should know how to handle the various formulas in the Excel sheet. Now I think Excels are brought in the academic itself. Even that syllabus alone is not adequate. In reality, it requires more skills. You should know the Excel skills, and including the macro form of writing, and macro way of programming. In the macro, it is required. That will help you to a great extent. Not only that, data, I said data is very important thing. To manage that data, you should have good knowledge with the MS Access or the SQL, sequential query language. If you know these things, it will be very easy for you to manage a huge amount of data. You cannot imagine in life insurance industry, there are huge data, even non-life, even health insurance. Wherever you go, it will be huge data will be there, and you need to manage those things. And in that, you should have some software. You cannot work on just like that one Excel or anything. You should know some sort of the software like the SQL sequential query language, and this one MS Access. These things will help you to manage the data effectively. So software skills is required. And now I think academically they are introducing R. So maybe it may happen in the future. The industry may start use that. I think as of now, none of the companies in the life insurance company in India are using the R software. Maybe in non-life there may be one or two companies. Maybe in future it may come. So I'm not sure about it, but it may be helpful to you. Modeling skills, as I said, data and assumption also okay to a certain level, not expected much from you, but modeling is very important. Learn, it is very interesting to do modeling. So if you take this as a challenge in your college studies, then it will be very much useful in your future career. Whatever industry you work, ultimately you need to do the modeling. Unless with that model, with that tool only, you'll be getting the output, the required output. So modeling skills are required. Focus on it. That will be very useful. Willingness to learn new things. Yes, this is very, very important. So the most expected from the student is, are you keen in learning new things? This will be very easy for any of your supervisor to train you properly. So I used to tell my team always, daily, you should learn something new while working. If at all you are not learning anything new, today, then your entire day is a waste of day. So I used to write what I have learned today, like that. I used to list out what are my new learnings today. So that gives me, at the end of the day, if you read that, then you'll have a satisfaction, right? That will make you, okay, today I have learned this one, tomorrow I will learn something new. That search in learning new things will make you an able professional, right? That will make you a qualified professional. Always you should have that search of learning new things. That will help you in a greater extent. Communication skills, friends. I always stress communication skills are very, very important, especially the people who are in the southern states. They lack this kind of skills. They know the concepts, but they are unable to communicate to the second person, the next person who is sitting. He may misjudge the people to whom he is addressing, and the communication becomes complicated. So that sort of thing should be avoided. We should know how to communicate the things to the other person.